So Pranav, since you mentioned about your fund, you have, like you have one of the best LPs, right now, like anyone can have. You have Mr. Mukesh Ambani's Reliance Ventures in your investing with you, Infosys co-founders Narayan Murthy, Mr. Chris Gopalakrishnan, promoters of Havels. Your fund has received like great interest from these investors. I always wonder, what does it take to start a fund in India?
Great question. Look, and the answer was without a track record, without being able to demonstrate performance, almost impossible to start a fund, right? And it's even more impossible, I would say, if that's a construct that's imaginable for someone who's 27, 28 to start a fund without a track record. Now, look, venture capital is an old boys game, right? It's an old boys club globally, not just in India. Who are typical VCs, MBAs, who spend time in industry, work in technology, usually operators or they're founders, right? They've started a company, exited, now they're a little bit senior, they don't want to start one more. They feel like giving back to the next generation of founders. So the important ingredient there is it takes time and experience, right? The very valuable track record of 10, 15, 20 years in industry it's almost impossible to shortcut.
Right.
So we realized that, Siddharth was 23, I was 27. There's no way some of India's smartest promoters, founders, the names you mentioned, are going to trust two kids with their very hard-earned money, right? Irrespective of whose relationship, whose ever son or daughter you may be, that matters to some extent because obviously they'll know you, they've seen you grow up and so on. But when you ask for money, it's a different game. They're going to treat you, they're going to shift gears and say, okay, we're talking business now. What can you show me that convince me to give you this money?
Right.
So we realized that look, there's no way we can build a track record with other people's money. That's impossible. So what we decided to do is we decided to start very small. We decided to pool up any capital we could collect ourselves, right? So completely internally contributed. So it's called a GP contribution. So 100% GP contribution. Start a very small fund. Now back then, the good thing was when we started, we saw an interesting climax in the macro environment where from 2011 to 2015, we had this very steady rise of VC. Every year, we were almost growing number of by 50, 60%, right? If 2013 was around, say, $1.5, $2 billion, 2014 was $2.5, $3 billion, right? So it was growing very, very quickly every year. But 2016 is when there was a sudden dip. If you remember, many companies crashed, many wallet companies died, many food delivery companies died. That was called the end of a bubble, and India's startup story is over. Everyone was writing the obituary for the Indian startup economy. So he said, okay, this is it. The crash has come, right? This is now going to be the most, if we had to start, it's now or never. So we literally scrambled and launched our first fund in 2016. And whatever money we could collect, the small fund, we put it together. And when we went out there to the market, we realized that all the companies who were looking for money were companies that their existing investors were not backing. That's a very important point, right? The existing investors had lost conviction in many of them. So we said, okay, this mainstream deal flow we should stay away from, right? So we'll go a little bit backward. We'll go deeper into the startup economy, and we'll try to find founders who not too many people know. Maybe the first time founders, good people with domain expertise. We won't dilute our expectation on their domain expertise, their knowledge, their quality. But they're not getting attention from the mainstream VCs because the mainstream is distracted by a lot of losses. And of course, now, even more importantly, some big winners are being created. So they were distracted by their big winners and the large number of losers, right? So we said, okay, let's stay away from the mainstream and we'll find interesting companies outside the mainstream that will be valuable in 1-2 years later after the crash has recovered and people have come back to investing. So in that churn is when we found our best companies today. If I look back in 5-6 years and which are our best performers, companies like Licious and Darwinbox and Better Place, I know half a dozen companies that are now 100, 200, 500 million dollars in valuation. We found all of them in this churn, right? And interestingly, I must say, the quality of those founders, fantastic people, right? What they built, the way they built their companies, very impressive stories. I'm pretty sure, they'll share their stories one day very soon. But, just such fantastic people. And the tragedy was that the mainstream, of VC was just not having the bandwidth to pay attention to them, right? So their seed rounds were, they were going around 2, 3, 4 months, and no one was willing to invest in their seed round. So we had a very interesting opportunity in that entire mix. And, I must say we took full advantage of it. And that gave us a very interesting portfolio that grew very rapidly in 18 months. So we made close to 40 investments in 18 months.
Okay.
That fund was doing well. So we were able to increase the fund size. We got more people to look at that fund and say, fantastic, okay, you know what, let's take the fund size up. And then, when we went and met the people you mentioned, we said, look, we already built a portfolio, look at the track record. This way, we have, hopefully, of course, it takes a long time to prove it, like I said before, but hopefully we made a good start and we can see this becoming a very high performant portfolio. And that's when we went to the market to launch our second fund. And, all things considered, thankfully, we were able to get the names that you mentioned. So the second fund was supposed to be 120 to 150 crores, ended up being 250 crores. They ended up being oversubscribed by almost 75%, and that turned out to be the fund that really established 314 as an interesting new type of approach to early stage in India.
Got it. Pranav, I'll request you if you can just share, this rare insight into how these high-level talks happen. Sort of like, how do you convince your LPs to, hey, give me money and not a Kalari Capital or like a K Capital, or a Matrix Partners India. How do these talks really happen?
Yeah, it's a great question. So there's no rule, there's no method to it, I would say. I know, I've spoken to many other VC funds, we're all in the same boat. Every VC fund has to launch a new fund every 3 to 4 years. So even VC funds are perennially raising, right? Just like startups are always perennially raising. So I think there are few things that I can share about the Indian LP system that we've learned over a decade. I've been studying this since 2011, so it took us 10 years to get it right. The first thing is most people internationally assume that because there is less Indian money in Indian startups, so overall if there's $10 billion invested in Indian startups every year, last year it was around 11.5, only 10 to 15% of that is from India, right? Indian capital, Indian HNIs, Indian pension funds, Indian insurance companies, blah, 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 Indian corporations. So 90% of our money in startups, in our best companies, is coming from outside.
Okay.
So when you go to the rest of the world, you go to Japan, you go to the US, you go to Canada, you go wherever, UK, and so on, and you talk to them about how you're raising money and how the Indian startup ecosystem is doing. The first question they ask is if you guys are doing so great, why is such little money coming from India itself? Right? It's a fair question to ask. So we dug into that. Why is there such less participation from India? Because startups are doing well and they've turned out to do much better than anyone expected, right, in that short period of time. And the first answer is there just was a cognitive dissonance between the owners of capital and the builders of value. So, for example, the large institutional capital, right, insurance companies, banks, corporate houses, so on and so forth. These are not foolish people. These are some of the smartest people in the country. What they've built, the way they've built it, the struggles they've gone through, the kind of regulation they had even 20, 30 years back when they started. It was a nightmarish experience for them. Very, very difficult to build value in this country back then, right? All of us know the stories. The biographies are written. So first of all, we must not disrespect them, right? That's a mistake many people make when they come to India. They say, oh, these people don't know anything. No, they know a lot. In fact, they know so much that they're very clear of the risks of putting too much money in things that are not developed enough too early, right? Being early is almost always a reason you can lose a lot of money. So there was this cognitive dissonance that had to be bridged. And they had to be credible people with a track record who've been doing it for a while, who put their own money at risk and who have success, to approach them and say, look, this is how we see it working. This is how we are approaching the build. This is how we think this value is going to be created. And this is how we think the value is going to grow, right? And this is the strategic value. This is how, this is the financial value. There had to be a bridge built between these two very different pillars of the economy, right? And that bridge building takes time in any country in the world. Even in the US, you can argue venture capital started in the 50s, really, right? With their first investments in aeronautics and the weapons manufacturing. And they've done such fantastic work in the US. The best engineers in the world have gone to the US and built that economy, right? So in India also, we've had waves of innovation. We've also had HAL, aeronautics, trains, locomotives. Then we had IT. Of course, IT has transformed the whole country, right? You can argue. So we've had waves of transformation, but the gap between the pools of capital and that the set of people who start, the entrepreneurs who start those businesses, it hadn't gotten to the point where startups were a part of that consciousness. So that building had to happen. So And I'm fortunate to be part of that building, right? We're one of the more interesting early stage Indian AIFs, Indian VC funds.
Right.
And we're very proud to say that a majority of our money is still Indian, right? And for us, going forward also, we'd be very proud if we could continue having more Indian capital participating in our story. So for us, that was the important bridge to build, and it takes time. There is no shortcut to that. It takes credibility, it takes a track record, it takes time, which is why we started young. Because for us, 314 is a 30-year story. That's why I said it's only 5-6 years in, so we're not even halfway through. And that's why I think if you're honest and if you're doing it the right way, I am very proud to say the names you mentioned. They're all very interested in helping to build the country. There is a very proud, very, I would say, patriotic thread amongst all of these Indian promoter families, the banks, everyone in India wants to see India succeed. And I think it's about building that bridge, and that takes time. And again, not everyone can build a bridge, and not everyone can be patient enough to spend 5-10 years doing that. So today, I would argue there's more consciousness about it's important to have an allocation to startup. Pension funds, all of the types of Indian capital that you can approach today are all now aware that it's important to have an investment in some fund, in some startups. They are now buying the pre-IPO stock of companies going public, Zomato and so on. So I think that participation has taken 10 years to become mainstream. I'm very proud to say now it is definitely mainstream.
Got it. Pranav, thanks for this elaborate answer and, lending me this rare insight, which probably only someone like a fund manager like you will have, because you've gone through that amazing sort of this experiential process. Pranav, I just want to ask you, you have one of some really cool investments right now, your story, Inc. 42, you have Dozy, you have Local. I just want to understand what is the sort of investment thesis you follow at 314, which makes you successful? And I'm sure this is a question which even the LPs who give you the money, I'm sort of ask you as well.
Absolutely. So, Asim, the simple answer is we need to study every market that we have access to in order to understand, are there real opportunities in those markets or not? Right. So, for example, we look at 5 broad sectors. We look at consumer, fintech, enterprise automation and SaaS, deep tech, and digital media. In each one of these 5 areas, there are many business models that are possible, right? And many different value propositions that can be built. So in consumer, you can build a consumer brand, you can build mobility, you can build education, you can build health. Even inside consumer, you have many different types of businesses entirely, right? So we have worked very hard, and again, it takes time to study every single vertical inside these focus areas and understand what the dynamics look like, how many customers are there, how much are they willing to spend. So it's a combination of top-down and bottom-up analysis that, unfortunately, there's no shortcut to. A market study, right? Many people try, many people go top-down. So, for example, in some of India's earliest funds were global funds acquiring Indian AMCs, asset management companies, and turning them into their India office, right? So that's today's largest funds in India are global funds, you can argue, and all of them started that way, right? And a lot of the early investments were a combination of what's working outside. Okay, let's try that here, and okay, we saw some interesting opportunity. There's no equivalent for this, but let's try it, right?
Got it.
And if you ask them what worked, then they say actually we had equal successes in both, equal failures in both, right? So the point is neither approach, top down nor bottom up, neither is a guarantee of being able to find interesting areas to invest in. So it's a combination and it's a lot of work. That's the short, real answer. And how we've done it is, again, it took us time. We had to study a lot. We had to do a lot of work before we could launch a fund, because it's a lot of risk, right? It's our own capital at risk as well. And we couldn't afford to not make it work. Let's put it that way. So the fact that we got it right meant that there's just more work, there's more urgency, there's just more discipline. And very importantly, there's a shared understanding of that market with the founders. So a lot of the work we do is validated from both sides. The founder validates their understanding of the market with us, and we validate ours with theirs. And when that match happens is when you realize, okay, we understand the opportunity the same way. Now let's figure out if we can work on something together. So all the companies you mentioned and many more, right? I think if you look at the common thread, it is the founders and us have a common understanding. That's one. And maybe two, the more important thing is both of us agree, both sides agree that we are a little early, meaning it's not something that everyone is investing in today, but it will be valuable in one, year two, year three down the road if we do this right.
Right.
So as early stage investors, if we're investing in what is already becoming popular today, then we're too late. Then there are larger funds, there are obviously larger pools of capital, they have access to global capital, they can compete for the same rounds, they can outvalue us on a Series A, for example. So it's very hard to be right and at the right time. that is a very competitive frontier. So we have to be early and right, which is even harder. So I would argue the best early stage funds I know, and the ones I modeled personally globally, most of them are in the US. Many of I was on campus. Theo's a great example. They're very sharply focused on how to become great at predicting what's next early enough, and they have the conviction to deliver capital and an agency into that model at that time. And if we do that consistently now, we've been trying for 6 years. So far so good, I would say. Certainly done well for us. But again, what worked last year is not going to work next year. So every year we need to reinvent ourselves.
Got it. Now, since you've talked about your investments and how important is the right place, right time, thinking about the future, because the time hasn't even happened yet. You take a long-term perspective to your investments, especially at early stage venture capital investing. What was Pranav your sort of investment which turned out to be a game changer for your fund? If I have to ask.
Oh yeah, it's a great question, and I know I seriously think that's the best question to ask any fund manager. Right? They are able to encapsulate how they think, how they work, and their track record in the answer. So look, I'll be very transparent about, and I have been very transparent about our successes. I'll pick on Licious because I think that's a fascinating story. So Licious, as you know, is now one of India's largest consumer brands. They're one of the fastest growing revenue businesses in consumer as well. And I would argue a category creator. Before Licious, that approach had never been taken in India. Right? No one had thought about, or even if they had thought about it, no one had attempted to build a full stack consumer brand in the protein space. So these two founders. The story I mentioned before is going around meeting everyone. They were very well connected. They're reasonably well known. One of the founders has come from a VC background, so knows all the mainstream funds. No one believed the story. Right? Everyone thought that these guys are going after a very narrow thesis, meaning very few people will pay extra rupees, hard-earned rupees, for something they eat every day, which is meat, protein, so on and so forth, at a premium. Right? Just because it's hygienic, just because it's safe, just because it's fresh. That's not enough of a reason to build a brand. So they were going everywhere, and obviously not finding enough fit with VCs. We got connected to them via a common friend, via a mutual acquaintance. And when they spent time with us, they spent time with Siddharth in Bangalore and my father MVP. I was just about coming back in, so there were a bunch of routines that I had to do with the move back. And they had the first meeting, and then we discussed internally, and they told me that this is something we should look into. And I said, wait, really? Protein, meat? Really? I don't see it, right? But then we spent time on it. We really understood, okay, why do people have a problem with this in this sector? Why is the buying behavior so broken? Why is the supply chain so broken, right? And there are layers and layers of problems here that for other people were a reason not to invest. For us, it was a reason, oh, wow, this is even more of a reason why we should help build this company. Because if we solve these problems layer by layer, the value we're unlocking here, and the fact that we can be part of a daily consumption habit, right? Food is, I can argue, something that people eat every day, and we can be a mainstream brand in daily consciousness, right? There's a brand for milk, there's a brand for rice, there's a brand for dal, there's a brand for almost everything that you're salt, everything you're consuming every day at home. There's no brand for this space, right? It's a complete white space. So It's so obvious and it's so difficult that if we succeed, the potential here is enormous. Right? So you can argue that's a foolish way of looking at it. It's a little too optimistic, but turns out that that's exactly what you need to be able to think about what's valuable in the future. Okay. So I'll fast forward, but in 6 years, like I said before, they're now one of the largest consumer brands in India in any space. Right. One of the fastest growing revenue bases we've seen. I wouldn't be surprised if they plan an IPO in a couple of years. And it's down to sheer execution. I would say the fanatic nature of these founders, that they will not compromise on the customer's end experience, no matter what happens. Even if they lose money on an order, they will make sure it's on time. They will make sure it's a quality that they promised. There's a no compromise attitude in that company, which I think, in spite of all the struggles in that space, that very difficult space, very challenging vertical to build any company in. I have to tell you that it's a very complicated business. But the fact that they pulled it through, it is sheer execution. It's not anything else. It's not been easy. But I think that story, I would say, even when I'm 50 years old, I will look back at that story and say, I'm still amazed at how these founders pulled it off. And of course, now it's up almost 400x for us since we first invested. So it's returning many multiples of our fund. So financially, it's done very well for us. But more importantly, as a proof point of how you can build India solutions in India and in very interesting ways, I think that story has been inspiring to so many people across the ecosystem. So that I would argue is a story I love to share all the time.
Thanks for sharing this very, very interesting your thought process on how it actually happened, your investment. Yeah, like it's a great story. I think I follow your funds investments very closely, and I think one of the best investments, according to me, is definitely going to be something like a Traction, or maybe or like one of the fintech sort of like investments like Open, Money on Click, doing some great work. And I'm sure, like, if I gave you like more time, you will just like there's so much to talk about the the kind of investments you made. But talking about success now, let me take you completely in a different spectrum. Pranav, success has many, you heard, has many fathers, but failure is an orphan. So now I just want to like touch upon, can you share one investment or maybe one company you passed on, which you thought, oh, I wish I had invested in this company?
Yeah, absolutely. So as many successes as we've had, we've also passed on companies that have become unicorns. So, for example, I don't want to say too many names because the founders are sensitive to how they pitched, who they pitched. But since these are fairly successful companies now, mostly going IPO soon, Nykaa is a great example. Again, Mrs. Nair, fantastic, unbelievable team, very clear about what value they're creating, how they're building it. But unfortunately for us, they came when we were in our fund one, right? And we were only N crores, very small fund. And they were raising a Series B at a very high valuation, and we just couldn't make the entry work. Even if we put, say, 10% of our fund in that one company in one round, we would have a very small ownership. So it just didn't make sense. It wasn't an early stage deal, right? So we had to pass on it with a lot of regret. So Nykaa, obviously, as you know, has become a very large company, will go IPO. Again, category creator, first time an Indian company is built what is built. Fantastic team. So that's one example of where, because of our limitations, we were missing good companies. Right? Same thing, we missed Curefit. Again, fantastic founder, great thesis. Again, a very large round. We couldn't make the entry work. So there are half a dozen companies like this where we couldn't make the entry work for whatever reason. And that shaped how we think about, okay, so fund size and check size and how, our capacity to enter in larger rounds was a gating factor to us having great companies in our portfolio. And it was a very important, valuable lesson because to Siddharth and me, we decided we can't allow size to be a constraint, right? Because our job is to be in the best companies in the early stage every year. That's it, full stop. We are measured by that, right? And best meaning the ones that perform. If I miss great companies every year consistently, then I'm not doing my job. I can't make excuses because I'm not doing my job. There's no excuse. So that shaped how we think about fund size, about check sizing, and a lot of how we do entry sizing and so on. And I'm very happy to say today, if we're closing an 800, 900 crore fund, it's because we are very sure that we need that flexibility to be able to never miss a great company if we want to invest in it.
Got it. Thanks for again lending this insight, because I'm sure like you learn a lot from especially missed opportunities, failures, and that sort of builds the foundation of like investing in the next big thing, identifying the trends, and sort of building as part of your firm's DNA, your